Thai events. 1, 2, 3, 4, 5, 6. Okay, great. I think we're going to remedy that starting this evening. You are not going to be the first timer anymore. You will be coming for the second time, third time, and umpteenth time, and you'll become hooked just like we are about Thai. So, thank you very much for coming. Anyway, for the benefit of those half dozen of you who are here for the first time, and of course for the faithful who's been here on a regular basis, let me just give a brief overview of Thai, and we'll get the program started soon. So maybe perhaps if the panelists could just take your seats over there, shall I say that would be a good one, rather than going and trekking back. So while I'm trying to, to get this. Okay, good. Thank you very much. Yeah. So my name is Vish Mishra. I'm the president of Thai Silicon Valley. Thai was started right here in Silicon Valley about 19 years ago by entrepreneurs, for entrepreneurs, and the genesis was that a lot of us came from South Asian countries, and we succeeded in America beyond our imagination, beyond our dreams, and we said, gee, wouldn't that be nice if we form a society and help anybody who wants to succeed as entrepreneurs? And so this is the core of Thai. So the people who really are behind Thai, we call them charter members, and they get invited to be a charter members. And because we look for the only two qualifications, either A, you have to be successful, and B, you have to be ready and willing to help others. And because it's a purely volunteer organization, and the membership is of individual level. So it's not, you could be with company A today and company B tomorrow, but it doesn't matter. You are invited to be a charter member on your own personal recognizance. So this is the single largest organization of just volunteer, highly successful volunteers. So our charter members are extraordinarily successful folks, and also they're extraordinarily generous. And so they give their time, they give their energy, they give their advice, and on top of that, they also make cash contribution to this organization. How we support ourselves? Very simple. Our members pay just a small dues, and then we collect some fees from from sponsors, as well as from our members who come to attend these kind of programs. Now, most of the programs we conduct here are right here, and we feed a good meal, and there's a good glass of wine or so. It's very so, and the fee that we charge just basically takes care of the meals. Okay, all the overhead is supported by other sources. Just to give you a sense, just last 3 years alone, okay, all we do at Thai, again, because we provide a lot of intellectual capital and just knowledge, advice, and sharing, and it's all done on a volunteer basis. We have, just 3 years alone, we have over 25,000 people have attended our Thai programs of this type. But basically, all programs boil into two categories. One is that, okay, we want to arm the entrepreneurs with all the tools that they need. So right from the inspiration, right from the information, right from education, right from getting them ready for the venture, and right from making them successful in the ventures. So that's one set of programs that we do. So tonight's panel is basically talking about how can you be successful in a venture, okay, and not talking M&A, because now you're in the growth stage, so how do you really realize your great exit for the company. The other set of programs are all industry specific. So Silicon Valley, because the cutting edge technology today are social, mobile, cloud, energy, and life sciences, primarily on the medical device side and on the healthcare IT. So those are the 5 sectors that we cover very, very liberally. So that's the nature of the program that we conduct. And when you talk about 25,000 people, I don't know of any organization that have that many people can come, year in and year out, almost 10,000 people per year. One of the things that we do is our grant program, which is called ThaiCon. This is the Thai flagship annual convention we hold right here in Silicon Valley, and this is 19th in the running now. I'm very happy to share, this is an absolutely joyous occasion for us. ThaiCon was voted among the top 10 best conferences for ideas and entrepreneurship by the Worth magazine. Okay, those of you know, Worth magazine is read by very high net worth individuals, 120,000 circulations, about 20 years old. And they have put us in the same league as the World Economic Forum and TED that most people are familiar with. So this is something, so all of you for Thai, this is for you. So congratulations, and thank you very, very much for really making this as successful. So just in this room today, because I mentioned that, okay, our backbone are the charter members, okay, and then I just wanted to just see, just show of hands, you have many such people are here. So we can raise your hand, who are the charter members? That'll be great. So thank you very much for coming. And without much ado, I'm going to just call on Shailesh and just a little background. And I'll just in particular single out Naveen, because Naveen is the chair. He's in the TIE board, and he oversees all the programs that we offer. And he had done a fabulous job this year, really tightening up the programs and trying to bring wonderful people, and also have chosen the best of the chairs for all the programs. And so Shailesh Shukla and Shali Jain are the two co-chairs for this growth company forum, as we call it. And I tell you, it can't get any better. I mean, look at the people over here. You got the top two corporations. You got HP and Cisco. You got the top two bankers, Goldman Sachs and Deutsche Bank. We got the top private equity from Silver Lake. And of course, we got the top lawyer who heads the M&A practice at Fenwick. I mean, it just cannot get any better. So you should feel very privileged that you are here. So please, listen to what they have to say, and please ask them as many questions, because I'm not think anybody is shy, okay, about answering the questions. So please. So with that, Shailesh, would you please come and just introduce the panel and the moderator? And
thank you, Vish.
Okay, wonderful. Thank you.
Hello, everybody. Good evening, and welcome to the fall event of the Growth Company Forum under the auspices of TIE. And of course, I want to make sure that I thank Naveen, who is the overall programs chair, and Kiran and all the folks in the TIE body here who have helped organize this. So my name is Shailesh Shukla, and I'm the co-chair for the Growth Company Forum, along with Shelly, who I see in the back there. I've joined this program recently. It seemed very exciting and seemed very interesting, and Naveen was very good in recruiting me. But this is a volunteer role. During the day, I worked with Hilton over here in Cisco as the general manager for the core routing business at Cisco. What I wanted to do was first make a shameless plug for Growth Company Forum, what it's about. Then I'll introduce the panel. Actually, I'll introduce what the topic for the panel is, and I'll introduce Doug. So, TIE is, of course, focused on early stage entrepreneurs, right? Helping them raise capital and write business plans and so on, network and get mentorship. But along the way, right, and TIE has been in operation for a decade and a half, we came to the conclusion that there was nothing within TIE that addressed the needs of a growing company, a mid-stage private company, or even a public company. In terms of mergers and acquisitions, in terms of raising additional growth capital, in terms of governance, and so on and so forth. So we decided to form this in 1999, or I should say 2009, it has taken off. There are about 4 events per year. Already, I think this year, this is the 3rd event, this is the fall event, and we are planning another one in November. So it's very exciting. This is Growth Company Forum. Anyone who's interested in volunteering or to help out, please contact either Shelly or myself. Okay? Thanks. So let's talk about the main event of the day here. M&A is an interesting topic. Right? It is at every stage of an M&A deal, before, during, and after the deal, it is part art and part science, right? And anybody who has been on either side of the table, either being an acquirer or an acquiree, knows that it's part art and part science, and there's a lot of luck involved. So what we decided to do was to focus today's event on understanding what are the trends in M&A, who's doing what are the key factors that make M&A successful, and why should you even look at M&A as an option for growing your business. So with that in mind, we set about to get the best possible panelists in the entire industry across different pieces of the value chain. So here, as Vish mentioned, we have the buyers, i.e. the principals, both corporates as well as private equity. The folks who advise them, i.e. investment bankers, Deutsche Bank and Goldman Sachs, and the folks who actually help close the deals, which is, and actually get them done on time, which is the lawyers, Fenwick and West. This is, I was doing some back of the envelope math. These guys have done, the 6 folks that are sitting in front of you, have done about $1 trillion worth of deals. Okay, $1 trillion. I'm not talking 50 billion, 100 billion, $1 trillion. So these are the best practitioners of the art and science of M&A. Okay? So please give them a round of applause. And it's also a little bit of a reunion of sorts, because I think many of folks here have done deals in the past together. Four of us did a deal about a year and a half ago. I did a deal with Ryan, almost 12 years ago, and so on. So what we decided to do was to have, Doug from Fenwick and West be the moderator. And I want to give you a sense of what Doug's background is, and then I'll turn it over to you, Doug. So Doug is a partner in the corporate group and co-chair of mergers and acquisitions at Fenwick and West, which, as all of us know, is one of the leading law firms specializing in technology and life sciences. His practice focuses on mergers and acquisitions, strategic and commercial transactions, corporate counseling, and financings. Mr. Kojan's practice also includes advising publicly traded and privately held companies with respect to corporate securities, commercial and intellectual property, licensing matters. He was a member of the firm's executive committee from 2005 to 2010. He's a highly decorated lawyer, right? He was named as the M&A Lawyer of the Year in 2010, and many other accolades which I will not mention. His bio is pretty extensive. He has done over $60 billion of deals. As of when this bio was written, I'm sure it's more like 100 now, including 70 deals with Cisco alone, right? Wow. So he's been doing a lot of deals with us at Cisco. So very exciting to have Doug here in a moderator and chair role. Welcome, Doug, and please introduce the panel and your plans for today. Thanks.
For a little bit of this, I'll stand up, and then I'll sit down. So thank you very much, Shailesh. And welcome. I think first let me introduce the panel so that everybody has a sense of who we have up here, and then I'm going to just ask a little bit about who we have in the audience, just so for everybody's benefit we can make the discussion as interesting and relevant for you. So let me just introduce who we have here. I'll start closest to me. We have Andy Johnson, who is the Vice President of Corporate Development from Hewlett-Packard. Andy's responsible for HP's M&A, their divestitures, their investments. We're going to talk a little bit, I think, later on about just sort of corporate investing and its relationship with M&A, which I think might be interesting, and also acquisition integration, which is, of course, I noticed in the advertisement for this event, one of the lines in it, which I'd asked to be taken out, but it somehow survived, with most M&A fails, and it was just said as an absolute, it was just said with complete, that was it, most M&A fails. So I think most people would agree, when M&A fails, it fails not because somebody paid too much for a company, it fails because the company was not successfully integrated, and so I think we should talk about that a little bit. Recent transactions for Andy read like the headline of the Wall Street Journal here: 3Com, 3Par, ArcSight, which I worked on, Fortify, and Vertica. So, and before Andy was at HP, he was the Vice President of Corporate Development at Brocade. Next to Andy is Hilton Romansky. Hilton is the Vice President and Head of Corporate Development at Cisco. He leads the entire corp dev function at Cisco, including M&A strategy and Cisco's investment portfolio, which I think is about $2 billion. So also a major corporate investor, not just acquirer. He has personally led 20 of Cisco's most significant acquisitions, including Starrett Networks, which was the deal that Shailesh was referring to, that half the people up here all worked on that deal on one side or another. Airspace, Tidal Software. And Hilton also sort of dabbles in the operating side at Cisco. He is the chief strategist for Cisco's service provider business unit, which is Cisco's largest. Next to Hilton, we have Ajay Shah. Ajay is the head of communications infrastructure investment banking at Deutsche Bank. He's the global head of that practice. Ajay received his MBA from Wharton, among about 6 other degrees that he has up here, but we'll leave it at that. Next to Ajay, we have Ryan LeMay, who is the head of communications and technology investment banking at Goldman Sachs, a small little operation down the street here. Ryan focuses on financing and strategic assignments for leading companies in the comms and technology space. He's been at Goldman since 1994. At the end of the line, we have our representative from the world of private equity, John Brennan. John is a managing director at Silver Lake Sumeru. Silver Lake Sumeru is the middle market strategy of Silver Lake. Silver Lake has sort of a few different ways they focus on deals. John is focused on the middle market piece. He's been at Silver Lake since 2008. Before that, he was at Adobe Systems, where he had a job very similar to what Andy and Hilton do. He was in corp dev and also was on the operating side and led the company's platform software business unit. So that's who we have here. Just in terms of who we have in the audience, I just want to get a quick show of hands from people, a little bit about what sectors you're in, because I think that'll be interesting just for everybody here to just get a handle on that, and the kinds of companies you're in. So quick show of hands. So who is currently working at a venture-backed private company? Who is at a public company right now? So that's interesting. So about 2 to 1 on that. Who is working in the networking space? Quite a few. Storage? Also quite a few. Telecoms in one form or another. Mobile. Internet. No, so it's a very, very interesting mixed crowd here. We got a little bit of everything, so that I think should make for an interesting discussion. So now I just need to quickly make a transition work here, which I may or may not be able to do without assistance. Thank you. You can see I'm a lawyer, not an engineer. So we're not going to have a ton of slides. I think it's more interesting for us to focus on the discussion. But I did want to just touch on a few. We have a mix of slides that were supplied by Goldman and by Deutsche Bank, so thank you to you both. So first is just, and hopefully this is clear enough to read. Probably not surprising for you to see that M&A volume generally tracks the stock market. I think this is just sort of the first and basic fact. And we're in such a volatile stock market that I think one of the themes we should be talking about tonight, and probably of interest to everybody, is what does that mean for M&A? Obviously, it makes things trickier to do a deal in sort of rough weather. And so I think that's something we'll want to get everybody's input on. But this is general M&A volume. Ryan, I think this is not just tech, right? This is all. And I think the lesson that part of what is being shown here is you can see the space where we currently are. We're in sort of we're below historical averages, but also we sort of have less M&A right now than maybe the stock market valuations would indicate. Ryan, anything else you want to comment on in this one?
Well, I would just highlight the bottom chart, which shows you M&A as a percent of global market cap. So global M&A volumes across all industries are the bars by year. And the line that goes across is the average over the entire, I don't know if that's 15 or 20 years going back in time. And if you look at the far right side, you'll see for the last 3 or 4 years, we've been significantly below the long-term average. And as Doug said, it's highly correlated to the direction of the market. You can see back in the 98, 99, 2000 time period, that's that middle chunk where you see the bars go way above the line. That's the internet bubble we all love and miss. And then you can see in just a handful of years ago, we also had a robust stock market as we came out of that tech decline, and the markets got a lot better. And you see the bars go above the line. So in really good environments, people are feeling bullish. You've got a lot of corporate confidence. People want to go and do things aggressively while their stock prices are high and while their businesses are doing well. That's often when you remodel and add highway into your house. Oh, sorry. Oh, thank you. Okay. And then when things get rougher, people tend to retrench, restructure. It's much harder to go and do M&A, and so you tend to see in tougher market environments, you tend to see the volumes go down relative to historical norms. And that means you've got sort of a double effect because I'm now normalizing everything to market cap. So when market cap goes down, if the percentage goes below the long-term average, you have a significant decline. And so the positive or the silver lining of this slide would say that at some point over the next year or two or three, as the economy hopefully recovers, we should see a very significant uptick in global M&A across all industries.
Thank you, Ryan. The next slide drills down a little bit into, as it loads, into similar sort of phenomena in the tech industry. So here you see tech as you'd expect. This is correlated to the NASDAQ, and you see similar effects here in terms of generally a following of the NASDAQ stock market, again, as a indicator of boardroom confidence, stocks up, feeling good, also trying to capture market transitions as you start to feel things starting to heat up again. Ajay, what else should we take away from this slide?
I think it's a drilling down of some of the trends that Ryan talked about. But what you're seeing here is over the last call it 4 to 6 quarters, companies that historically have not or have been doing acquisitions, they have used this I guess time of really low valuations combined with really low cost of borrowing to go out and do big acquisitions, really industry-defining acquisitions. I mean, if you think about it over the last 4 quarters, some of the tech companies have done their biggest acquisitions ever, including Google. We had Microsoft do huge acquisitions. Obviously, HP and Cisco continued to acquire companies. So this chart just shows that corporates have clearly taken advantage of some of the really low valuations and also low cost of borrowing to continue to acquire.
Now, as we sort of drill into this one a little bit, you see some interesting trends. So this one, I think, it once you think about it, it makes perfect sense. As stock prices go down, in order to get a deal done, the company still has a certain amount of inherent value. And so what that ends up meaning is the premium gets bigger because the stock price is lower, but the company's value is still inherent. And so I think it's just we're in an interesting environment again where you're seeing very strong premiums paid for companies as stock prices have gotten depressed. And so that's a lot of the, and just to hit the next one, here's some data from Goldman just in terms of average deal premium. I apologize, the numbers are a little bit hard to read here. But what you can see is, over the last couple of years, solid premiums in the 40s, ranging in the 40s, whereas, just a few years ago, somebody said, what's your average M&A premium? Probably somebody's gut reaction would be sort of in the 30s. And so you can just see there's a real difference there. The other trend, which is probably not surprising to anybody when you think about it, almost all cash, right? Deals are being done for cash now because stock is undervalued. People don't want to use their stock. If anything, corporates are buying back their stock. They're not using it in acquisitions. And just look how different it was, 10 years ago when half the deals that were done had a stock component to them. So I'm going to ask Ajay to sort of speak a little bit, help set the table here, because this was touched on earlier, that we're sort of I liked his phrase, affordability index. So Ajay, you want to take us through this slide?
Again, apologies for the eye chart nature of this slide, but bankers try to squeeze a lot of data on one page, making it difficult for clients to read. And this is a classic example here. So just believe me. But what this shows is on the top half there are three line charts. The one on the left shows the level of cash that corporates have continued to put on their balance sheet or continue to have on their balance sheets. So back in, if you look at 2004, 5, 6, the total corporate cash as a percentage of the market cap was in the, call it mid to high single digits. And over time, that level of cash has been increasing significantly. Companies, becoming more profitable or continuing to raise cash because of the, low cost of financing. As an example, Apple today has about $75 billion of cash on its balance sheet. Right, it's much larger than some of the economies out there in the world. And that cash is about 20-25% of their market cap. I mean, it's a huge amount of cash. Same thing with HP, Cisco, Google, and Microsoft, and others. The chart in the middle shows that the cost of financing just to go out and raise capital for companies that are highly rated, a single AA rating, that cost of financing has continued to come down, which allows a lot of these corporates to go out, raise some really cheap capital, and use that capital to use either through acquiring companies or, in some cases, buying back their stock as well. What the chart on the extreme right shows is over the same period of time, you see the valuations of companies as we've gone through and hit some bumps in the road around the economy. The valuations of these companies have been coming down. The S&P today is trading at about 13 times earnings, forward earnings, which back in about 2004-2005 timeframe, it was in the high teens, low 20s. So that just has driven the valuations of these companies low. So when you think about all these three combined together, increasing amount of cash, cheap, cost of borrowing, and at the same time valuations going down, it really spurs that M&A activity that we've been seeing lately. And that's pretty much the takeaway from this chart. There's just one final point I would make on the bottom of this chart, which is the M&A Affordability Index, as we call it, which is, again, this all it does is looks at acquiring companies using cash because cost of capital is really low, and seeing how that translates into companies, and as they think about acquiring companies, is this accretive to our earnings or not? And so clearly the companies have been using a lot of cash lately because the cash is cheap and it is really accretive to the bottom line, which again entices them to do more acquisitions.
Thank you. And one thing we'll talk about a little bit later also, but I think I want to keep it moving a little bit more right now, is how much more valuable a transaction is outside of the United States, because a lot of the cash that Ajay was just talking about that corporates have up here, including the folks who are sitting at this panel, is offshore. And so to repatriate that cash comes with a huge tax hit. And so to use that cash offshore to acquire an offshore company is tremendously, I think John said it was 2 turns of EBITDA, simply because if you can acquire the same company offshore and then acquire it here. And so that's just something I think is an interesting theme to talk a little bit about in this room. But our last slide is also an eye chart, but an interesting eye chart, so I want to have it anyway. So Ryan, I'm going to ask you to just take us through this, because I just think it's very interesting. What Goldman's done is sort of group deals according to sort of the deal logic of the deal. And I think it's just sort of an interesting way to think about it, and it'll start kicking off some of our panel discussion.
Sure. Well, consistent with what Ajay said, if you try to summarize, as the title says, the general themes driving tech M&A activity on one slide, you have to cram a lot of stuff onto it. And you also have to make some really sweeping generalizations. And we've put together multiple iterations of this slide and debated who goes into what bucket and move deals around. But by and large, I think you can make a few generalizations about the types of deals or the categories of deals that have been prevalent over the last handful of years in tech M&A. And the first is really what we call filling out the stack. And there's been a huge focus, not only in the investment banking world, but I would argue, and we can certainly ask our colleagues from HP and Cisco, about the fact that you've seen a huge convergence of IT where people are trying to sell more things across the data center stack and across the product portfolio. And you can look at what's happened in a lot of the enterprise deals in particular over the last couple of years, where people are just adding more and more pieces that their sales team can then sell into the enterprise customer, both to make them more relevant, but also to give them more things to sell. And so there are a lot of examples here. You can pick almost any of the large cap enterprise-oriented technology companies and identify a handful of transactions that fit that theme. You can see we've highlighted a handful for Dell, Perot, SecureWorks on the security side, EqualLogic, and a handful of others. EMC, Data Domain, and Greenplum. HP, lots and lots of deals. Microsoft and Oracle, same thing. So that's theme number one, and that's probably the most prevalent right now, and I suspect that's going to likely continue for some time. The second is getting into new markets, new products, new geographies, and I think you can really best summarize this by just saying growth. And we may talk about that more as we get deeper into the discussion tonight, but a huge theme for many of these acquirers has been picking up things that are growing. And I would argue that most technology M&A is growth-centric, and that's the first and foremost thing that people are looking for when they buy companies. And you'll see lots of transactions here. Again, many of the same buyers acquiring companies that are growing quite rapidly in very attractive markets, geographies, or in a new product space where they have some compelling technology. And lots of examples there. The Starent deal that Doug mentioned that many of us worked on clearly fits into that category. Qualcomm Atheros, another good example from earlier this year. There's also a category less prevalent but increasingly prevalent, and certainly relative to if you went back 10 or 15 years, you have to really struggle to find a true consolidation deal in technology. It's hard to come up with some. If you look over the last 5 or 10 years, there have been a lot more. And so that would be the third theme of essentially acquiring a competitor, obvious cost reduction, obvious synergies. Oracle's probably the most famous for doing this and arguably doing it quite well. And then the fourth category, which John can talk about probably better than I can, is what we call financial engineering. That's effectively private equity oriented transactions, taking companies private or doing deals that have very complicated structures where there's a heavy dose of the financial engineering. I had the benefit of working on the going private deal of Airvana a year and a half ago, I guess it was, which was a company in Boston in the wireless space that didn't trade particularly well in public markets. The owners didn't like the story very much. Went private and is doing phenomenally well as a private company. And then the last one, and probably newly emerging, is what we call the post-PC era, and what happens in this new world of mobile things, and as the concept of sitting behind a PC in your office sort of goes away. And I think you've got 2 deals here, Google and obviously Microsoft Skype, that are maybe just 2 of the leading edge transactions in that world. I think there'll be a lot more to come there.
Great, thank you, Ryan. That was terrific. So I think what I'll then ask some of our panelists to do is just talk a little bit about what they are focused on, what they're seeing, what sectors are most interesting, and we'll sort of take it from there. So I think I'll ask John to start, and I'm sorry, ask Andy to start. And we'll come to John and just sort of get a different take for private equity. I want to sort of explain and have some insight into sort of private equity deals and sort of how they're different. I think that'll be interesting too. But let's start with the corporate side, I think. So Andy, tell us a little bit about what you're focused on at HP these days, what sectors, how you see the world in late 2011 and heading into 2012.
It's on.
I mean, that's certainly a broad question, and there's a couple people from my team here. I should probably ask them as a little bit of a test. But it's funny. Be curious what Hilton thinks. But I mean, HP is a big company, and there's very few things we're probably not looking at these days. I mean, obviously, with the autonomy project, we're very focused on integrating that. There's a lot of applicability of the autonomy software throughout divisions of HP. So, unlike a traditional deal where we buy a company, it fits into one division. With autonomy, it actually fits in a lot of places. So I think you may see us, overweight to autonomy integration here for a quarter or so while we think about what's next. But I do think, despite what you read, we sort of have a very classic framework on how we look at deals across the company, and the people in the printing division, are eager to do some deals. The people in the PC division, we'll, depending on what we announce around that spin, if we decide to keep it, they'll obviously be interested in doing deals. The people in our server and storage and networking team are obviously interested in deals. So we, part of the challenge in a big company is how do we prioritize across the different groups. But it's fair to say that there's probably not too much we're not looking at these days. If you go from kind of our PC to our printers to our enterprise business, and it's smaller deals and it's larger deals. We don't have any defined metrics on, we're only looking at deals of a certain size. We don't tend to talk a lot about our smaller deals we do, so people may not be as aware, but I think, without saying too much, because the danger of these questions is saying too much about our inside information, but we're pretty open about what the strategy is around kind of connectivity, what we want to do in the enterprise and software. So I think what we say is probably pretty directional about what we're interested in.
No, thank you. No, autonomy is a very interesting deal. I was involved in selling interwoven to autonomy, and the applicability of their technology to so many different things is really, I think, going to be very interesting for HP to fully build out. Hilton, similar question for Cisco.
Yeah, I think Andy's comments covered, actually on, yeah, it is, covered a lot of the way that we think about things as well. Yeah, I would just comment on some of Ryan's remarks and where we see ourselves in the categories that he was going through. You know, I do think that we have been historically, and I think will continue to be, looking to M&A as a primary driver for our growth strategy in the first couple of categories, right? So, you know, there are always going to be gaps in the stated strategy and capabilities inside the company, and so that's just part of what we do. It's part of how we've gotten to where we've gotten, and it will continue to be a big growth driver for the company, is being able to fill out a portfolio inorganically, where we set the strategy principally to grow, both through building capabilities internally and then being able to pull talent, skills, and IPR from outside where it makes sense. I do think that around the growth component, which is a place we've been very active as well, you know, we've oscillated between going and doing things that sort of feel like bigger pearls in a string of pearls. Starn, I actually think, is one of those deals. And also using acquisition as a way to enter into new markets. And you know, I think very much the comments about seeking growth through acquisition, I think that resonates. And I think that that's both true from a geographic perspective. DVN's a good example of that in China, as well as in things like aerospace, where it really was a resounding sort of statement about where we're going to be in the .11 space, you know, 6 or 7 years ago. I think that looking forward, you know, these trends relative to valuation in the marketplace and activity, you know, we watch the daily swings in stock price very, very closely. And it affects not just things that are on our mind relative to the public markets potentially in the near term or in the long term, but also affects obviously the potential exit profile and opportunity for private companies and obviously what are on their minds relative to their options. And so I think that, you know, that actually has created, rather than a period where you've got prolonged depression or compression of multiples, or a period where you've got relatively high multiples, but a period now where you've got sort of a significant up and down, a very tough set of dialogues that we have tended to have with startups and mid-sized companies who I think have a valuation disconnect to where we have tended to be. So it's tough to have that discussion when, you know, your stock price just a few days before may be, you know, 20, 30% different than it was on the day that you had the conversation, or certainly if you're a company that's trying to do an IPO and you can go one day but the next day it seems like the window's closed. So we watch that very closely. It's a big part of the way that we're calculating how we do things and when. In terms of areas, you know, core is critical to us. You know, the business that Shailesh you know, runs within Cisco is one of the most critical components of how we're going to continue to grow and develop as a company. And so around core, we're going to continue to look at M&A and investments to be able to go and drive software differentiation as well as in silicon, right, to defend the core. It's critical. And then I think in the growth businesses, which now make up about 30% of our revenues and grow at a significantly higher rate, video, right, is a big focus for us. We've been very open about that. We just announced a transaction today with BNI Video to fill out our Videoscape strategy. It's going to be a place where we're going to continue to be active. Collaboration, obviously, has been a big area for us as a company. We're going to be aggressive and active in that space. DC and cloud, virtualization. And I would say outside of the identified core areas or growth areas, I think mobility and security, right, as it relates to the core, I would identify separately as areas of focus where you're going to see us continuing to be very active both on the equity investment side as well as in trying to fill out the portfolio.
Thank you. You know, it's interesting. So, you know, for both the corporates up here, you can announce a deal and sometimes the market just doesn't get it. And you're trying to articulate how it fits in with the strategy. Or sometimes the deal is just not as accretive as the market likes. And so, but there's a logic to the deal that needs to be conveyed. And I thought I'd ask maybe the bankers just, how do you sort of help the client with moments like that where they're looking at a deal, it's clearly important from a long-term strategic point of view. And there's a lot of questions, obviously, in the boardroom about how the market's going to react when it's a real game-changing deal, and are they going to get it? Ryan, you want to comment on that?
I'd say it's all about persuasion. No, it's definitely an issue, Doug, and it certainly comes up. But I would say, for the most part, that issue, for most, and it'd be interesting to see what these guys think, but for most of the big acquirers, they're not as focused on day 1, day 10, day 30 market reaction. Certainly, it comes up in the context of negotiations. The quarter's going to be X, Y, or Z. We're going to have to, deferred revenue goes away. I'm going to miss my whatever. So I think it's a negotiating tool at times. But I think most big companies have a strategy. I think certainly both HP and Cisco, in my experience with them, they have a strategy. And if the thing that they're looking at buying fits the strategy, they're willing to sort of see through the short-term market shareholder kinds of reactions and do the right things for their business and not be so worried about the ups and downs. Now, there are companies that do care about that, particularly in the smaller and more mid-sized companies, particularly ones that trade at really high multiples, where they do worry a lot about the market reaction and the ability to get things done. But even then, I think in many cases, when a buyer is willing to pay a premium price for an asset, there's a strategic reason why they want to do it, and they want to deal with that. And the deal that Shailesh referenced earlier on that we worked on a long time ago was the Redback acquisition of Ciara, where Redback essentially gave up 42% of the company, I think, which was at that time, I don't know, $4 or $5 billion of market cap in then dollars, to buy a private company called Ciara that had no revenue, had no product, which was a pretty novel thing to do. And we did spend a lot of time actually on that transaction, on how do you actually take this to the market and tell the shareholders of Redback that they just gave up a huge chunk of the company for a company that's pre-product. Now, that was a slightly different time in the market. It's a little more easy to do then than it might be to do today. But at the end of the day, what you ultimately have to do is sort of work through what is the strategy, what is the vision, and convince people of that. And if you're on the selling side of the equation, there's a lot of storytelling and sort of vision building and helping the buyer understand why this fits in the strategy, why it makes sense, what the companies can do together. And you're on the buying side, you're very focused on how to take that story to the shareholders and explain it in a way that shareholders will understand.
Thank you. So Ajay, in your experience currently, are the private company targets you're trying to bring to the acquirers, do they have realistic valuation expectations? For that matter, do public company targets have realistic valuation expectations when it comes to the M&A context, just given the volatility and given the environment we're in?
Yeah, that's a great question. What I've found generally is nobody has rational expectations. The buyers always want to pay less, and the sellers always want more. It's about how are you going to convince whoever your client is that if it's a seller that's the right value, or if it's a buyer that's the right value you're paying. And a lot has got to do with emotions, sentiments, and really what's happening with the market. If you're a private company, you've got nothing to do with public markets. I mean, you're not your stock is not trading, and there's no real public value. But you look at one of the companies which has a very high valuation, and you point to that company and saying, that's the company that I should be compared against, and we should get the 200% premium. And whereas on the other side, you buyers who are saying, but you are a private company, you haven't made a single dime in your entire life, and you want how much for that? So it's always a interesting boardroom discussion around how do you rationalize valuation, and at the end of the day, as Ryan said, it's about persuasion, but it's also beauty is in the eyes of the beholder. The seller really needs to understand what this transaction does for that seller himself or herself, and the rest of the constituencies at the private company, whether it's the boards, the employees, and what is the right long-term kind of outlook for the company, and what is their right long-term strategy versus on the buyer side. These days clearly it's a buyer's market, has been for a while. They have several options, and the buyers also need to really understand and study the market and really convince themselves that the company that they're trying to buy is actually worth the valuation that they ultimately will have to end up paying.
Yeah, I mean, markets, you can give the advice that markets can often remain irrational longer than you can remain solid. So one should be careful. John, help us understand a little bit about how Silver Lake thinks about deals, about private equity deals, and how they differ sort of from a corporate transaction, and give us a little introduction sort of to how you guys approach deal doing.
Sure. For those of you who may not be familiar, Silver Lake is a private equity firm. We're not a venture capitalist in the sense that we don't invest in businesses that don't have technology or a team yet. We invest in businesses that are established. But we invest in those businesses from a relatively small size up through very, very large businesses like Skype. I will point out that we wouldn't call Skype financial engineering, as you pointed out on your slide there. We think we did a whole lot of fundamental work there, but we'll come back to that off the stage. Look, I think one difference here is that I am both a buyer and a seller of businesses, and I don't think my colleagues from Cisco or from HP buy a business with the intention of ultimately selling that business, but I do. I buy a business with the intention, or I buy a piece of a business. I make an investment with the intention of selling it ultimately, and selling it for more, hopefully a lot more than I invested in it. And so price matters to me quite a bit. Price matters because obviously there's that spread. I want to buy it at some number. I want to make a set of improvements, help the management team get a bigger business, and then sell it. So that's one kind of important distinction that I think is worth pointing out. We point the companies that we're invested in. We point them towards thinking about a sale relatively early in our involvement, and we do that because we think it's a good discipline for them to go through the process of thinking what it means to be a company that is prepared to have an IPO or be sold to a strategic buyer. And in fact, if you look at many of our companies, Skype is a great example. We were very public about the fact that we had a strategy of taking Skype public. In fact, we filed an S1 and made it very clear that that was the path we're on. And one of our views is that forces a discipline into the company about thinking about what it will take, both fundamentally in terms of the business, for it to be interesting to a set of investors, in that case the public market investors, but if public market investors are interested, then corporate strategic should be interested. So it forces them to think fundamentally about that, but then it also forces us to think, frankly, about the cosmetic aspects of getting ready for that process too, because in addition to being a great business, we want it to look like a great business. And so we go through that process pretty early, and we force our companies, we ask our companies to think about that relatively early, even if we are focused on building the core business, through that process. We do a lot of work on the core business, though, I will say. I mean, it's not a process of just we buy it and then we sell it. I mean, in the case of Skype, as an example, just in defense of myself here for a minute, financial engineering. Okay. That's a business where very typically, we started new product lines, and we brought in a lot of new folks to drive different initiatives, et cetera. And then, but part of that is very much thinking about where it can ultimately land.
An interesting statistic, by the way, is the relative likelihood that a successful venture-backed private company will be acquired versus go public. Anybody want to hazard a guess about what the ratio is there? Yeah, 20 to 1. 20 to 1 in good times, 20 to 1. There have been periods, brief shining periods, like in bubbles, where that number gets closer to sort of a 10 to 1. And I think in one moment, maybe in 99, 2000, it was 8 to 1 or something like that. But generally, 20 to 1 is more the norm. So I mean, that's just something to sort of keep in mind in terms of likely exits and liquidity events. One trend I'd love everybody's perspective on who wants to contribute it is the IP-centric deal, which we're just seeing manifest itself in a lot of small deals, medium deals, and blockbuster deals like Google Moto. From everybody's perspective here, I mean, there's a private equity angle. There's from the banker's perspective and from the corporate's perspective in terms of girding up for IP wars. Who'd like to comment on sort of where this trend seems to be going? Are we just at the beginning of it? Where do what's your take on sort of IP-centric M&A?
So Doug, just to clarify, are you talking about deals where that's the only asset?
Where that is the primary asset, and probably if somebody from Google is on this panel, they would dispute whether that was the primary asset. We don't need to dispute that deal here, but assume that's the primary asset in the transaction.
Yeah, so I don't know how Cisco operates, but I would say from an M&A perspective, HP, I don't think it's become a dominant factor when we look at what I call very classic M&A. We really are looking for, if it's a small company, do they have technology and product we want? Do they have a team we want? If it's a public company, say like an ArcSight, does it take us into a new area that we want to go? But my IP colleagues at HP would